Alrighty, let's go ahead and get started. Welcome everyone to TradeFinder Live. Great to be back with you all during this trading day and during trading hours. First and foremost, as always, we do need to cover our disclosure disclaimer agreement. The main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing's to be taken as personal investment advice. It's always available on our website to be read in full detail at your leisure, or feel free to take a screenshot of it now if you like. That's the main point to take away. Hoping everyone had a great extended holiday weekend. I know I did with the races that we got to watch between the Monaco and Indy 500. I'm sure Rob will have some comments around that. And also with the market seems to like the pause between the EU tariffs from the administration over the weekend as well. And so I'm wondering if that means we can go higher from here. Rob, you out there?
Hey, I'm Zach. Happy beginning of the week to you. Happy Tuesday afternoon to everyone. I second Zach's comments of hoping everybody had a great holiday weekend. And we'll see if we can continue this momentum that we had this morning. We also had some positive economic data on the back of President Trump pausing the EU tariff. He had complained that they weren't negotiating and he didn't want to negotiate, but apparently that was just more leverage. And we don't have a whole lot of details on what the EU has said, but perhaps they've said they actually do want to go ahead and negotiate something. So all this tariffs, then pause, etc. It's all interesting, but if we just look at the charts, we take a look at the S&P, we're actually going through some pretty normal technical patterns here. 575 was the key level that we needed to break. I didn't like the fact that we gapped above it, trade a little bit higher, and I was hoping that we would have a test sooner, but we tested it on Friday, and now today we are back above the 10-day moving average, which means that we can reasonably assume that we have a good chance of extending up to this 161.8% fib level on the C wave of this zigzag. You can see the B wave was about a 50% correction, and 100% is your target. So we gapped above that, and if you've been watching, you know by now that at this point in time, we look for an extended C wave. This point in time, meaning that we have broken the initial target, but we did need to come back and test 575 first. So the key will be, can we close above the 10-day moving average today? If so, then we are likely headed up towards that 161.8% level, which would bring us back to the highs from both December and February, which would be quite interesting considering the movement that we had back down here. And a lot of us feel like the tariff stuff is the short-term news, seemed like maybe it put a little bit of a shock into the markets, but also feels like that was a good excuse for some profit taking, which the market needed. The market needed this little bit of a correction. And there you can see we moved down to the 138.2% extension on the downward zigzag. And after only a 38.2% B wave correction, our first target was 61.8. Then the extended target is 100%. But we had that overcorrection all the way down to 138.2. And so we were pretty darn extended on this downward zigzag, but held right at that fib level. And now we've been marching back to the upside from here. So the market seems to now have a space to go up to that extended 161.8% level. We'll have to wait and see how the bond market reacts, acting a little bit better this morning. Yields are down, so I'll go ahead and move over there. Zach was talking about the race in Monaco. For those of you that are Formula One fans, know that pretty much qualifying is going to determine who wins the race because you can't pass there. So wasn't a good race for my guy Max with Red Bull, but they seem to be performing a little bit better the past few weeks. Hopefully they got their act together. But when we look at the bond market, TLT, perhaps we're at an area where we can get some continued move back up in prices. You can see this zigzag here. Once again, 38.2% B wave correction. That gives you a 61.8% extension. And we extended past that all the way to the 100% level. So that's what we're talking about on the opposite direction, the upside on the S&P. And I would argue that these two coincide pretty well. As you know by now, the bond market really does drive what happens in the equities market. And when a zigzag completes, the likelihood is that you retrace the C wave. Sometimes you retrace the entire zigzag, but the first move is to retrace the C wave. So if we can get a continued move up in prices and therefore down in rates, that could be the ammunition, the energy, momentum that the S&P needs to get up and reach that 161.8% level and just right back to the highs that we had, as I mentioned before, in December and February. So we're starting to look towards rate cuts now. We'll wait and see if there's going to be two. Some have said there's still going to be three, even though the Fed Fund Futures is pricing in two. September being the first month, and then a toss of a coin between October and December. I talked about that in the U.S. market update over the weekend as well. So far, that's what you have to look towards. That's what the charts are saying at this point in time, and that's all we can do as technical traders is analyze the data that we have at any given moment. But looks pretty constructive at this point. If we take a look at the VIX, we are stubbornly holding that 17.5 level. We had moved up. We're back down underneath this 22.5 level at this moment in time. We're back down under here, just under 20 right now as we speak. And perhaps we come back down and test that 17.5 level again. We held there for last week, basically the entire week, just sitting on that 17.5 level. Then we had the bounce up towards the very end of the week. And then now we'll see if that does act as resistance, this 22.5 level, and we move back down. That seems to be in the cards as well. And if we move back down towards 17.5 or even one of these lower brackets here at 15 or 12.5, once again, ammunition for the S&P to go higher. So we'll continue to monitor all that. I know a lot of you like TNX, so we'll take a look at that. We won't see today's bar yet. Well, actually, we do. So the data's come in, and we are ticking down just a bit on the 10-year as well. We had this breakout of this symmetrical triangle, and talking about different Elliott wave rules. When you have a triangle, even though this wasn't a really well-formed triangle, we had a pretty decent set of lower highs, but I don't like these big gaps. I like triangles that form with multiple touches of the two trend lines, the trend line of lower highs and the trend line of higher lows. The more touches, the better, in my opinion. So this wasn't great with this opening, but there was consolidation, and that's really all I'm looking for when we're drawing these triangles is there consolidation. You can see we had this little better formed triangle on the TNX back here in February, and we broke to the downside out of that one. And now it looks like we're breaking to the upside. And once again, reminder for those of you that might be newer, any triangle can break either direction. It doesn't matter whether it's ascending, symmetrical, or descending. Any triangle can break either way. That's what the data shows, regardless of what you may read out there on the internet of getting you to lean one way or the other. Elliott was very cautious of that. Don't get caught picking a direction. When you have a triangle, know that it can go either direction. And that's one of the things that we like to highlight. Let's take a look at the dollar real quick before we go to the rest of the markets. And the only issue here is, do we give up this level? If we start breaking, if we break this level here of support just above where the wave 3 low was, that would be the next target. So there'd be another target pretty quick. So there's a corridor right here where I would personally like to see the dollar hold. We don't want to lose the dollar. Then all of a sudden that starts to bring other things into play. Maybe the dollar's just going down with the look ahead towards whenever the rate cuts may be. or maybe something else is going on with the dollar. You've seen all the commentary, I'm sure you've read about it, that um, other countries that hold so much of our currency, our bonds, our treasuries, et cetera, are selling some off. They're not buying as much, and that was causing rates to go up on the auctions. But maybe we get all these trade deals worked out and everybody's playing nice again. I don't think, when they talk about China and how China could hurt the U.S. a lot by dumping the holdings of bonds, treasuries, and currencies. But why would they want to do that? China needs us. We are the consumption engine of the world, and they need us to buy their stuff that they make. Same thing with India and Vietnam at this point in time, regardless of where manufacturing is occurring. Well, they still need us to consume it. So they got to be real careful not to. I'm going to leave this arrow on, not to upset the apple cart too much here in the U.S. because if they cause a heavy recession in the U.S. economy, that hurts their economies as well because we don't have the power to consume as much. The U.S. consumer is pretty strong. They buy and they'll buy on debt. We'll do whatever, but there is a limit, especially when credit cards are high and car loans, et cetera, with slightly higher rates, et cetera. All that stuff matters. And they just have to try to balance this out. So I think some of those actions are their shots across the bow, if you will. President Trump uses tariffs. They can use their holdings of our bonds, treasuries, and currencies as their leverage on their side. And that's how the game works, right? And people flex their muscles, they use the leverage they have, and then hopefully they get to the table and they work some sort of a agreement somewhere in between, a compromise, if you will. And hopefully that's all that's going on. But we do still need to watch the dollar. I would be concerned if we broke this 97.5 level. I didn't really want us to break back below 100, but we are testing this first level. And then again, we have that low from April that could still hold. But with all that said, we have a fairly well-formed five-wave to the downside pattern here. The algorithm is not sure about the wave four. It's not confirmed yet. It's just qualified. We did come up and tap the 50-day moving average, which is where the algorithm labeled the wave four. And there's the potential of moving down and taking out this wave three low on a new wave five low. So I just, if we break below this 97.5 level, then it starts to get kind of dicey as far as how far down the dollar can go. So even though the market is moving to the upside today, rallying on the news, also some probably relief that there wasn't anything really negative that came out over the 3-day holiday weekend. And we're getting a little bit of a relief rally today. Can we hold it into the close? Seems like a pretty strong rally at this point in time, but still a lot of time between now and the close, as you know. Now let's take a look at the Dow, the DIA. This is the market that I felt was really interesting at the beginning of last week because it had broken above its resistance level at 420, and now we're right back down and broke below it, tested the 50-day moving average on Friday, and we're right at it today. So if we can turn around and get right back and close above this 10-day moving average and then get a follow-through day tomorrow, I think there's some pretty good room to run here. You see this vacuum of space right here. More room on the DIA for advancement, I would argue, than the SPY. And we have these highs back in February and December as well, and they're a little bit further away than the Dow. So the Dow's been underperforming the S&P, and maybe that's where some money goes if we get some renewed follow through here. The conservative money will wait and see if we take out this high right here that we set back in the beginning, or excuse me, the middle of May. This high here, if we can break above that, we really have no resistance, clean air with the racing vernacular to move up towards 450. But first things first, we have to close above 420 today, and we need to follow it through tomorrow. So a couple things to keep an eye on there on the Dow, but I do think that that could be an interesting place to look for maybe a little bit of outperformance with the markets moving forward. So that's the S&P and the Dow. Let's see what the Qs look like, and they're a little trickier because they're right underneath resistance. So it's trickier than in the fact that we got to get back above 525. We got to get back above this resistance level. And then if we do, we have another corridor here. So where the dollar has a corridor of support, the Qs have a corridor of resistance. So not only do we have to get above 525, but we need to move above, and I'll give you the exact price here of where those highs were. Call it 540. We'll just round it up. We need to get the Qs back above 540, and then if we do, we're likely coming in this area of this old wave 5 target from back in February. So perhaps we can get a break there. It's just you have to take into account that even a break above 525 is going to bump its head again pretty quickly there at the 540 level. So little slower movement perhaps here. There are some tech stocks that are moving this morning. Is that going to be enough to propel it above 540? To me, that's where the Qs become interesting. It's almost not enough movement here for consideration at this point in time. You might as well just wait and see if we can break that 540 level. And then the IWM, which is one of our current case study considerations. By the way, reviewing the case study considerations that we've had, we closed out the NTES one this morning for a really nice gain. It exceeded our target in much less time than we expected. So that was a really nice winner from our previous case study considerations. We still have the IWM with the expectation to go up to 220. I saw on the voting, and Zach will come in a little bit later on and show you how to post an idea on the social media aspect of the Hub software. And if you are new and by the chance you haven't gotten a copy of this software, go to hubb.com. It's free, get free Elliott Wave. Great piece of software. There is an opportunity to subscribe to the AI signals if you want them, but you don't have to do that. You can just go through and get the free Elliott Wave if you want. But that NTES trade was an AI trade. And just to give you a quick look at that chart, and then we'll come back, look a little bit more at the IWM. But when we take a look at NTES, NetEase, you can see there's the AI target. It had a nice high score, 84. And I told you I wasn't going to do this every week, but we did it this week, and that was really good timing. We had the gap up on earnings, consolidated a bit here in a triangle. There's a lower highs, higher lows, and we're breaking out again today. So we're going even further. So we've exceeded even what the AI target was, and we were able to close this out at a much bigger gain than where the target was. And that happens sometimes, and it's really nice when the AI does this. Note that when the signal came out, we had a little bit of a move down, and then we turned and exploded back to the upside. And that happens a lot because the AI identifies the first day of a wave 3. That's one of the 300 plus data points the AI uses. And sometimes it's catching these momentum runs, and they continue in the momentum run, or they back up just as NetEase did and test resistance before moving higher. So back to the IWM, which is one of the current ones. We still have that level at 220. And my point was going to be that when you vote, not as many people agreed with this one as with some of the other ones. So that's always interesting. And that's one of the great things about the social media aspect is you can disagree if you want to. Zach's always talking about it. I'm sure you'll talk about it again today as well, that opposing opinions are what makes markets. You can't have a market if everybody views the same way. You need to have bulls and bears, buyers and sellers. So didn't mean to steal your thunder there, Zach, but it was appropriate at this point in time because that was interesting, and we'll see how it plays out. If we can close here today, we're back above the 10-day moving average. We tested support at 200 at the end of last week. We tested the 50-day moving average, and maybe the Russell is ready to try to take another run. Be really interesting to see how that plays out. So that covers all the U.S. markets. We'll take a look at the metals. So let's go to GLD. Maybe where we're going to break out. That's what it looked like on Friday of this triangle. GLD, if you haven't been watching over the years, does this all the time. It's just uh, programmed into it almost, it seems like, where the GLD will consolidate, break out, consolidate, and break out. It doesn't always break out to the upside. Sometimes it breaks to the downside, obviously, but it just consolidates a lot. And so it's fun to trade with strangles, etc. As far as the breakouts, the only problem is as gold is getting higher and GLD, therefore higher in price, the strangles become a bit more expensive. And so you can make an argument that rather than pay the price for the strangle, let it break out and then trade that direction. And the fact that it broke out on Friday, but right back down into the triangle, is why we constantly harp on that need for a follow through or confirmation day. Lots of head fakes in the market, and gold gave us one. They're in GLD. We'll see if it can hold this 10-day moving average and try again. But if you jumped in on Friday, it's down today. And then we'll look at silver. Still waiting on silver to play catch up. And I have been talking about how there's two different ways that this can occur. We can have SLV break to the upside and have a big run and match gold because it hasn't. It's been lagging so far. Or we could have the opposite where GLD breaks to the downside out of its triangle and comes back down and then mirrors the SLV again. So usually they move relatively similar fashion. They don't have to have the exact patterns, but they normally move in a very similar way, and they haven't been. They've been diverging with GLD greatly outperforming, reasserting itself as Big Brother, if you will. And you know, in the past, we've talked about how gold was Big Brother, and then silver took the lead, and gold has wrestled it back now. So gold is back to being king again, at least for now. But which way do we go in order to get these two back in alignment? Once again, gold breaking down or silver breaking to the upside and outperforming. That'll be something to keep an eye on there with the metals. If we go and take a look at the crypto space, been doing pretty well. I show BITB. It's optional. I really like it. Some of you posted on the US market update over the weekend that you like IBIT better. It's optionable as well. Has pretty decent liquidity. So whatever your preference is, this is just the one that I've been trading, and we'll compare. That's the way you figure out which one's the best. Do a direct comparison on the performance and see. But they're very similar patterns, obviously, because they're both dealing with Bitcoin. But I like it because they're optionable. And the key here is on Bitcoin is we are breaking above resistance here on the BITB. We're a little bit above the 10-day moving average, so maybe not any sort of a big sprint to the upside in the near future, but we can go, well, it's the black screen of death, so we'll wait till that comes back. Computer acting up this morning. But then we'll see if we can consolidate, do some backing and filling, and then turn and move back to the upside from there. That'll be the key to keep an eye on for BITB. And let's see if we can get it back. I might have to log out and log back in. It doesn't like these computer blips. We do have some pretty squirrely weather going on up here in the mountains.
Weather will cause that, and while you're waiting for that page
Yeah.
to load back up, I thought it might be a good time to maybe talk about your Zigzag Mastery series that's coming up.
Good point. We do have um, a great zigzag mastery class coming up. And Zach, I think you'll put the link. See, this is Google, just so everybody knows. This is not the software's issue. This is my computer doing this. But the Zigzag Mastery class coming up, Zach will put the link in there for you. If you like the zigzags, I know there's some misnomers out there about zigzags. I've had the comments on the US market update that, zigzag, why do you keep looking at it from a directional standpoint? It's a corrective pattern. It's a corrective pattern because it's labeled that. The flat zigzag and triangles are the corrective patterns. And the reason that they're known as corrective patterns is because one of those normally occurs following the completion of a 5-wave Elliott wave pattern. And that's why they're called corrective patterns. But the zigzag, as you've seen, is a directional pattern, and it's only 3 segments long instead of 5. I really like the fact that it helps with the wave 3. Pretty much anyone in the world of Elliott wave agrees wave 3 is the strongest, but a lot of people tell you stay away from it because it's hard to know where the wave 3 is going to end and the 4 is going to begin. And let the wave 1, 2, 3, and 4 form, and then trade the directional move in the wave 5. Well, with zigzags, they show up in all those. I like them in the wave 3 and 5 when you have a directional 5-wave pattern. The wave 4 sometimes has a zigzag, doesn't always, even though the wave 4 is a corrective pattern as well. So if those are things that you'd like to learn more about, that's exactly what this course is designed for, is to give you some really in-depth, deep dive, if you will, to use the current buzzwords that are out there in the marketplace on zigzag patterns. I think it's something everybody should utilize. They're shorter term. We're in a period of shorter attention spans. We're programmed for instant gratification, even with watching YouTube shorts or whatever multimedia platform that you're looking at for TikTok, whatever, for the short videos. Everybody likes things shorter term. So let's do that with Elliott wave as well. 3-wave pattern versus 5 happens much quicker. And then getting back over here to where we're on, thanks for that reminder, Zach. And then take a look at the chart of Ethereum, which is really trying to outperform Bitcoin here. We had a really nice run, really good, solid consolidation here right at the point of resistance. This is what you want. You don't want it to go vertical like this and continue higher, because what goes vertically up oftentimes comes vertically back down. You've heard that rule as well. And what happens if you're already overbought, when you break a resistance point, it tends not to hold. It's going to fall apart and come back down. But when you have a run up like this nice consolidation, let the 10-day moving average catch up, test it a few times, and then try to break it again, that's when you have something that can sustain itself. And this, I think, is really interesting because look right here, of all this clean air, once again, another similar chart to what I was showing you with the DIA, where there's a big opening ahead, almost a vacuum. We oftentimes talk about vacuums to the downside. When if a stock breaks support, it could free fall until it hits the next level of support. But it works the opposite way as well. When you're running to the upside and you have this open space, you can get a big run here. So is Ethereum going to outperform Bitcoin moving forward? We'll see. I like the chart set up there. So far, I really like Ethereum's chart better than Bitcoin's. And then some of you, I'm sure, will disagree with that, and that's fine. And then I like the Dow's chart better than the S&Ps and even the Qs. The Qs have the work to do with resistance. The S&P has an opening to go higher, but not as much room as the DIA does. And same thing here with Ethereum. Let's move to the energy space. Take a look at natural gas. You know the drill here. We've been talking about it forever with the potential of this wave 5 impulsive move. We came down and formed the wave 4, barely held on to a qualified Elliott wave pattern at that 78.6%, the last fib level. We broke up, looked like we were off and running. That's when we posted this. Is this a wave 5 impulse move? Nope, came back down, but we are consolidating nicely here in this triangle. So this is where that rule comes in. Even though you're looking at this and it's a qualified 5-wave pattern to the upside, this triangle means you have to respect that we could break lower as well. So if we break down out of this pattern, on natural gas and break below this wave 4, then we'll be down at 12 and a half pretty darn fast. If you're bullish on natural gas, you really want this triangle to break to the upside. But just because the triangle is formed in a wave 5 does not mean it's going to break to the upside. It might, but it might just as well break to the downside. It's a toss of a coin as far as which way it's going to go. But at least if it breaks to the upside, we have a potential target range on where it could go. If it breaks down and breaks below 15, the best we can do is look at the next level of support at 12 and a half, see if some new Elliott wave pattern forms or what happens there. You could argue, I think, that if things do calm down, if we start looking towards the rate cuts, if all the tariff stuff is going a little bit better, we keep getting these pauses, which I think means that the administration is at least encouraged by some of the negotiations that are going on, then that could be ammunition for companies to come out and start talking about building the data centers again. That was, as you remember, what put the bid under natural gas back here, is when all of a sudden the realization was these companies are going to be building all these data centers and they're going to run on natural gas. So that put the bid under it, and then we retraced it back. Again, advertising the zigzag mastery class. And we've got a lot of people signed up for that already. So join us. Let's have a great group and some great conversations. But here's an example of when the zigzag completed and it retraced the entire zigzag. Remember, I was talking about when a zigzag ends, normally you retrace the C wave. And so we came down there, and actually that was the A wave on a downward zigzag. And then we had the B correction and the C wave on the downward zigzag retraced the A wave on the upward zigzag. So all this stuff, these things work. That's why I show you, and you can see it, the Fib levels, time after time. And if you're a believer in the Fibonacci levels acting as support and resistance, whatever other viewpoints you may have on math and mathematical order of the universe and all that kind of stuff, and the Fibonacci spiral, and all the different extensions of Fibonacci ratios in life. We're talking about in the world of trading, and the Fibonacci ratios act as amazing points of support and resistance. Let's go ahead and take a look at oil, and it's also helping a little bit. We've got a pretty nice symmetrical triangle formed here in USO, and I looked at the options and they were a little pricey, but we're going to look at them again today and see if maybe we have a little bit of calming with the VIX coming back down a little bit and more consolidation here. We might be able to put a strangle on USO moving forward. Also, you can see the ADX is diving down now. It's below 15, which is where I like it. I really like it when it's in the 13 range, but below 15 is positive. That's one of the things that I look for. I just want to be clear that you don't have to have a low VIX for a triangle to break out. But I like to look at a lower VIX when I'm putting strangles on triangles, because the ADX is a measurement of the strength of a trend. Normally that ADX is going up if you have a trend, whether it's to the upside or the downside, the ADX goes up because it's not measuring direction, it's measuring strength of the current move. So when the ADX goes low, that tells you you're trendless, you're consolidating. That's what you want with a triangle, because if the ADX is higher and you have a nice triangle, what can happen is you can consolidate more and form a larger triangle. And with a strangle, when you're buying a call and buying a put, theta decay, time decay, is the number one enemy. And the longer that it takes for the breakout, the more time decay is eroded before the breakout occurs. So the closer you can get to the actual breakout point, the better the strangle is going to perform. And that's why I like having that low ADX as part of the trading system for putting on strangles. So we're having some good charts here to give a lot of good Elliott wave education as we get ready for that zigzag mastery class, so master class. Let's move on to taking a look at some of the rest of the markets. So we've covered the metals, we've covered energy, we've covered cryptos. Let's see what's going on around the world here a little bit. And with all the symbols that we look at in the U.S. market update every weekend, we don't do the international markets as much, just in an effort of time, so the videos don't get so incredibly long. You can see that even though this wave 4 is still labeled, it's at 88%. So this is a disqualified Elliott wave pattern. So you just take that off and you look at the chart without the Elliott wave on. And somebody mentioned in the US market update about the ABCs on the zigzags. And they said that can't be the software drawing those. Man, it's not. There's a zigzag tool that I utilize that the Hub organization actually built for me because I like to draw my own zigzags. And if you can let the software do it, you get a lot of ABCs on your chart because it's looking for all three flat zigzags and triangles. So lots of ABCs on the chart. I like cleaner charts and I like to draw my own zigzags. So you can agree or disagree. That's fine. I'm really comfortable with the way I draw zigzags, and you can learn more about the way I do it in that class. But I just wanted to clarify that no, the software isn't drawing those. I'm doing that with that tool. But if you want it to be automated, you can. You can just go up, turn the Elliott wave button on, and go up here where you have the Elliott wave little settings tool there, the little toggle. Click on that, and you can turn those ABC points on. So here's the tap box that you can set. I have it done with Fibonacci levels. You can do it with statistical probability as well. And then here's where the box is that if you want the software to draw those ABCs on there for you, you just tick that box or check that box depending on where you are in the world. It means the same thing, just a different way of stating it. But notice that that box is not checked on mine, so they don't show up. So thought I would take that opportunity to clarify that. So getting back to Australia, taking the Elliott wave pattern off, we just look at where we are with support and resistance. We've got a nice impulsive move here. We'll get a correction at some point in time, but for now, that looks like that could be a new impulse A wave. We'll see. We've got a little bit more room before we run into resistance, which was where the triangle formed back in November. And we've taken out this high from February, and doesn't seem much to stop it. It's not a whole lot more room, to be honest, but we got a little resistance here, not too far ahead above 26, and we'll see how that plays out. And then the one that's just really had me shaking my head for quite some time, the Canadian market, the EWC representing Canada. Look at that move. Talk about an impulse move. Just boom. It's like, yeah, they came down with us when all the tariff stuff got heavy and the U.S. markets went down so much and corrected. But all in all, considering all the rhetoric that's gone back and forth between the U.S. and Canada, the EWC has performed remarkably well. It's really mind-boggling. So you can see it is in a wave 3. And if we look at the DMI, that's pretty darn solid. The ADX is only between 30 and 35. The positive directional indicator is still above the ADX, which means it's highly likely that ADX will go up to at least 40. In other words, looks like more to go to the upside here on the EWC. The only negative is that we're getting a little bit of separation with today's move above the 10-day moving average. So if the markets hold all these gains into the close, maybe we get a little bit of a pause over the next couple of days. Some sideways movement consolidation would be great for all of these extended moves that are occurring today. And then we go over to Germany, and all we did is just follow the 10-day moving average. Every time we got a little bit away from it, that rule of no security in any time frame gets too far from the 10-day moving average, at least not for long. You can see it so clearly on this chart of the EWG. Get a little separation, boom, right back down. Get a little separation, boom, right back down. Separation, back down. Separation, back, every time. And it works if you're below it too. It doesn't have to just be above it. You get too far below it, right back up. I think of all the rules that I give to our subscribers at ewotrader.com, the one that the subscribers have really, really liked is this 10-day moving average rule. A lot of people have added that into their trading toolbox. It's a great one. You can look at any chart and see something very similar to this, but this is a really good example of it. Every time we separate, we come back down to it. Every single time it's occurred for the entire year, that's happened. And now we're in this tap box on the wave 5 and we're extended at 116%. Maybe we get a little bit of a break here or a pause on the EWG at some point within this tap box. Otherwise, that 5 is going to relabel to a 3 and we start over again. But for now, it's just a well-formed, spot-on Elliott wave 5-wave pattern on the EWG. Let's take a look at the Nifty for our friends in India. We have a lot of people that ask about this. A lot of people follow the market in India. And I've talked about this. We've got this nice old-fashioned trend channel here. Sometimes old school technical analysis can be worked in with Elliott wave, AI, all those things. But some of the old tried and true stuff I put on my chart as well. Just you can see just this plain old trend channel of higher highs and higher lows here. We're in the upper end of it. The wave 5 finished down here beyond 100%, which means you only look for a 61.8% correction. We went boom right to it, came back down, made a higher low, went up, made a new high, came back down, and formed this trend channel to the upside. But we are at a point that could continue to act as resistance here where we retrace the entire wave 4, which once again on Elliott wave rules, if the wave 5 goes beyond 100%, you only look for a 61.8% correction, that part that it did immediately. However, if a wave 5 finishes below 100%, the rules are you retrace back to the previous 4. Well, this did it even with a wave 5 that extended beyond 100%. So this is going to act as resistance here at this previous wave 4. And if we can break above that, or how easily do we break above it, we're consolidating nicely right now. There's a pretty big gap up here to 62.5. So we could have a pretty quick move up here to 62.5 on the Nifty if we can break above this level where we are. So I think I would be just a little patient here, let it break above, get up to 60, and then you can start looking to that move to 62.5. So be a little cautious right now, but keep an eye on that. It should be on your watch list. And then FXI, which is the other case study consideration that we have open, the only two that we have still open in our TradeFinder listing on the platform for case study considerations that we do each and every week. We broke above the 10-day moving average. Things look good. We have some room up to 37.5. And we're pulling back a little bit here. I want to see that back above that 10-day moving average. This movement up following the 10-day moving average and then testing it, all that's fine. Maybe we have to come back down and test 35 again. We did go sideways here before breaking up. And when you have that kind of a movement, you can sometimes just run up to that next resistance level. In this case, it seems like the FXI may look to come back down to 35 first. We'll have to wait and see. Again, the next couple of days mean a lot on whether or not we can jump right back above that 10-day moving average or test 35 again first. But I think 35 is pretty solid level of support. The rhetoric between the U.S. and China seems to be a lot friendlier, and perhaps that gives us an opportunity to move up. Zach, let's go ahead and grab a few questions. Snowflake, SNOW, is going to be our case study consideration today, and Zach will come in after the Q&A and show you how to post an idea as he posts that one for us this week. So, Zach, let's do some questions.
Sounds like a plan. Excuse me. Let's get right into it. We got a question here from Irv on AMD.
Every week now with AMD, it seems like. Let's take a look and see. We had the first move above that 100 level, which it did rather nicely. Slow movement here on the breakout from the triangle. And 120 was next. That's where the trend line was. It's exactly where we hit and then backed off. So doing exactly what it's supposed to do. It has held this 10-day moving average here and the level around 110. And looks like we're trying to bounce back up again. At this point, though, this move was the one that was kind of telegraphed with the support resistance areas. I think I would just watch this now and see if we can get above that 120 level. If we can, then 140 is highly likely next. But at this point, let's not jump the gun here. Let's let it break 120. Then we can look for the move up to 140. But certainly a renewed bid under advanced micro, which was not the case moving into the lows of April, where it was just working its way down. But perhaps we're playing a little bit of catch up here as well. We have to note that it is in a 5-wave to the downside pattern, so we need to take out this wave 4 first. It was at a 50% corrective move, so that, along with the 120 level, were two pretty difficult things to get through quickly. And that's why we got the consolidation and the test back down to the 10-day moving average. Now maybe it gathers itself and tries to break 120, but that's what I'd want to see there before going long AMD again.
Thanks, Rob. Let's follow that up with Uber for Jim.
I haven't looked at Uber in a while, so let's take a look here. We do have this is the leftover, and that's one of the cool features of the software is when you draw lines, put the zigzag on, you can make your own notations here, all those things. It remembers it from when you were there before. So this is the posting when we closed out a trade on Uber before. You can see it had reached our AI target here. So another example of the AI, we'd gotten there and we had separated from the 10-day moving average, and we went sideways for 1, 2, 3, 4, 5 days and then tried to break up and then have come back down. So in this case, that AI target is holding. On NetEase, we blew through it, but you can see how the stock Uber is really struggling with that AI target price. So where we go from here, I think we have to wait and see. I look at the DMI with that wave 3, that ADX had gotten up, didn't quite make it to 40, so there is more room for it to run. The consolidation could be viewed as constructive that we're going through right here. I'll go ahead and take these arrows off now and look at this consolidation here. With the 10-day moving average right in this range, you would want it to hold this corridor here right around 85. If it continues to pull back, to go long again, it would need to have a clean break of 90, get that positive directional indicator back above the ADX. So the possibility is there, but the AI, it's already reached that target.
Followed up by CRWD for Will.
Good old CrowdStrike. And nice move to the upside today. Look at this DMI. The ADX breaking above 20 today. Great separation between the two directional indicators. They're moving vertically each way. We're breaking above resistance at 450. I think that CrowdStrike has room to run. We closed above it on Friday. We're getting follow through today. The DMI is setting up really well. I like that one, Will. I think CrowdStrike goes higher. And you can see these two zigzags here. Starting, for those of you that don't know, every single 5-wave pattern starts with a zigzag. So there it was. And we went up to the extended 100% level. So that one reached its not only target of 61.8, but the extension. And then we also have another zigzag right here, which is the complex C wave of the original one. And that can give us a target up here that happens to coincide with that big round number of 500. So you've got the DMI being supportive of the strength of this move. You're breaking resistance. You've got a C wave zigzag target at 500. It's a big round number. We've talked about the old tractor beam effect from Star Trek days. Those big round numbers just tend to draw the stocks to them. I think there's a really good chance CrowdStrike hits 500.
GME for Lisa.
GameStop, gosh, um, people still look at that, huh? Um, they're doing some things that have worked out well. Um, every time the stock takes off on one of these runs, the management is selling shares and padding their balance sheet with the idea that they need to expand the business plan a little bit, the business model, and they have the cash to do it. And we're off on another one of those runs. We are overbought right now, though. There's no way I would chase this now, but I've said that with GameStop in the past, and it's gone a lot higher. This one's just really, really tricky with all the meme crowd and momentum traders that get in this. There is no doubt we are overbought from the 10-day moving average. We've gone vertically up. For me to take a look at going long GameStop, I would want to see it come back down, test 32 and a half, hold it, let the 10-day moving average catch up, and then trade it to the upside. Now, who knows with this stock? It could continue to go vertically up, and I just miss it. And I'm okay with that because it's a very, very volatile stock, and you're going to be paying that in the options. So if you trade options on this, I would look to do a call spread rather than straight calls so that you balance out some of that volatility there. But big move today, and we'll just see how it handles this overbought condition. If you were in it, great, congratulations. But try not to get greedy on this move. But as I said, the stock can do anything at any time. So I would just um, trade it the way you feel comfortably. I'm not sure I would listen to what I have to say on this one.
Fair enough. A lot of volatility in that stock. And Lisa commented saying I made a deal with the GME devil today, wrote a bull put spread on 26.27 for GME.
I like that trade. If you're going to trade it, that was a good idea. Yeah, I like that.
Smart thinking there. Let's look at
Yep.
Baba for Maria.
Good old Alibaba. And it's going to kind of move with FXI. Um, tried to get above 130, came back down, and we're just kind of hovering in this area here where all the major moving averages are. Take this off so you can see it right through here is where I'd like to see it consolidate. But knowing that because it had this triangle and broke up, it could come back down to the point of the triangle. Remember, that's one of the Elliott wave rules of triangles that at some point in time it's going to come back and test the point of the triangle. It retraces the breakout move. And it works like gaps. You don't know exactly when that's going to occur. Sometimes it happens rather quickly. Other times it takes a while. So there's no rhyme or reason as to the timing that occurs. But that is a possibility, especially with it trending down below the 10-day moving average. But we'll keep an eye on how that works with that area up there in the 130 range. But I'd like to see it from a bullish standpoint back above the 10-day moving average rather quickly. They have earnings. Did they already have earnings? Yeah, they got a dividend coming up on June 12th. So it doesn't seem like the stock would go down too much because people want to hold the stock and collect that dividend, even though that's not nearly as big a deal as it once was because companies have been using their excess cash for stock buybacks rather than paying dividends. But when you have a dividend coming up, it's a deterrent for people to sell the stock so they can collect the dividend. It doesn't necessarily mean it's going to go up. It usually just means that it's not going to come down too far. And then after the dividend, people can reassess if they want to continue to hold it. Let's do one
All
or two
right.
more, and then you can move
I was
to
actually going to
posting
say, with
Snowflake.
us being right at time, perhaps we'll head over to the platform and post the idea. I don't know if you wanted to provide a quick review on what the case study consideration was going to be, or I can just go straight over to it.
It's going to be on Snowflake. Um, And you see we're in a wave three. If you look at the DMI, another like Will's CrowdStrike, this is very well supported by the DMI. Good confirmation there on the strength of the move. We are a little bit overbought, so be aware of that. We could pull back down. We could even come back and test this, but breaking above this 200 level today is key. It's another one of those big round numbers. And so we're also breaking above that wave five high back from February. It looks like we're going to go up to this 261.8% fib level. So that's my expectation. Um, Snowflake up to 220. That's going to be this week's case study consideration. So we do something a little bit different. So,
Very well. Thanks, Rob. Let's go ahead and head over to the platform now. I'll take the screen from you.
all right.
Righty. And should be able to see my screen now. So here we are at the platform menu view of everything that this platform has to offer. We'll go up here to the right toolbar to click on the light bulb for ideas. And Rob's is going to be an official idea for this week or a post.
It'll be an idea.
Idea, very well. So we'll go over to new idea, create a new idea here. And as I've said, probably sound like a broken record to some, but creating an idea could be equated to paper trading with your brokerage. Going to have all the real-time data and information as if you were in an actual position for this trade, just no real risk or capital on the line. The symbol is snow for snowflake. Go over to a target price of, that was 220.
220, yes.
Very well. And what time frame are we looking at for that?
Let's give this some time. Let's do the 3 months with the fact that we're a tiny bit overbought right now.
Very well. So as we can see here, we have these fixed intervals of time to select. I'm going to go ahead and go with the quarter, the 3 months. We will make this look nice and pretty here right after the session is complete, but I am going to go ahead and confirm, publish this idea. So it's now available, as you can see, for you to come in and interact. And just as a quick review, as Rob mentioned earlier in the session, opposing opinions is what makes markets. So whether you agree or disagree, we welcome your opinion. Just obviously be considerate of the community and have your supporting evidence, whether, again, you agree or disagree with this idea. So other than that, I think we'll just wrap up with a final reminder to register for that Zigzag Mastery Series. Going to be lots of exciting material to indulge in and to internalize during the 4 different sessions in total for that series. So I'll pass back over to you, Rob, to add any thoughts there and wrap things up.
Yeah, you made a good point that it is 4 sessions long. So we're going to be talking about a lot of things regarding it. And if you've been curious about the zigzag, maybe you haven't been a believer in it. I know because I can see some of the comments on the U.S. market update each week. But if you want to learn more about it, whether or not you decide to put that in your toolbox or not, this is a class for it. So again, hope everybody enjoyed a long holiday weekend. We're back and running with a new trading week, and right now the rally is holding, and they're adding to it nicely. So it does look like we are going to close above that level on the 10-day moving average again here on the SPY, and that should give us some room now to move up. Obviously, assuming that we get the follow-through day tomorrow back up to those highs in February. It's going to be really interesting to see, but also keep an eye on the Dow. I just have a feeling that that one may play some catch up here. Thanks for your attention as always. We value your time and do our best to make it informative and educational. Zach, thanks for your work behind the scenes, and have a great rest of your trading day, and look forward to talking again soon.